Um, Hi, Michael Bego. Thank you very much for accepting my accepting to be on in my podcast, Vol de la Finance. Thank you very much.
Yeah, thank you. I'm super excited. And we were just talking a minute ago. I think it's great that you have an audience of a lot of people looking to get their careers going and interested in secondary. So thank you. I'm honored.
So, could you briefly introduce yourself and explain in few words what is Kline Hill?
Great. So my name is Michael Bego. I started Kleinhill 10 years ago, and we are a secondary fund. And what we do is we provide liquidity to others who invest in private equity assets. And those are usually institutions, and their capital is all tied up in these illiquid assets. So they want to get out, and unlike public stocks, you can't just sell. So my business in the secondary industry buys what they own for cash,
Mhm.
and then we are then the investors in these assets.
Okay, so we're gonna talk about this in the podcast, but maybe first, could you talk about the key milestones in your career before founding Kleinhill Partners?
Sure. And this answer I took a little longer on than some other answers. And I think part of it dials back to like being open-minded and thinking a little bit differently than everybody does. And even I credit some of that to like very beginning when I was super young. So my best friend, starting when I was 10 years old, his family were they were Persian from Iran.
Okay.
And instead of using a knife and fork, they'd use a fork and a spoon. Cut with a spoon, shovel the food on
Mhm.
the use a
Like
fork to shovel the food
pasta.
on, and you eat it.
Hmm.
And it like it's better. It's better than how everybody else ate. And like you're like, wow, like just something simple like that makes you think different, right? And then a few years later, I was had a job mowing grass. And the guy I was mowing grass with, he was like, listen, in the United States, these political parties are crazy. They're both a little bit nuts, the Republicans, Democrats. He's like, and he had a different way to view that was sort of different
Hmm.
and opened my eyes to like, hey, all these people who seem so powerful might not be the best.
Yeah.
Like maybe they have a lot of good aspects, but think differently. Um, and uh and so that was like a second aspect of like the way to think different. Then in out of university, I got a job where I had to run projects. So I'd go to big manufacturing companies, and I was actually in a 3-month training program along with 24 other people on how to use this software that would help you schedule factories. And after it was like 2 or 3 weeks, they needed someone to run a project. They pulled me out, wasn't
Hmm.
trained. They kicked me to Slidell, Louisiana, to a Folger coffee plant, and I like didn't know anything. 2 weeks out of undergrad. And, uh, and basically the advice I got from my boss then, he was like, listen, you only need to know what you need to do tomorrow. So like each
Hmm.
night I'd be studying up with the manuals and making plans on like how to be successful the next day. And it sort of and like I did that for years, initially by myself and then running like an 18-person project a few years later.
Wow.
And but it forced me on like how do you get the job done and owning like making things happen. So that was important. And then in I don't know, I ran a turnaround a few years later. I was involved in sales, like selling software, which had
Okay.
gone really well for me. I was helping people sell a lot, and those conversations were successful, so they pulled me into more. And then right before the secondary world, I worked for a McKinsey when they really teach you how to be polished and professional.
Of course.
And so it was all these different little experiences that were completely different from each other, I think taught me a lot along the way. It took me a dozen years from
Okay.
university to get to secondaries. It's a long road.
Wow. But how did you discover secondaries? Like you just talked about McKinsey and several experiences that do not are not related to the secondaries market. How did you
Yeah.
discover this?
So one of the experiences I skipped was in 2000, May of 2000. I got into venture capital secondaries
Okay.
right as the dot-com bubble burst, right? So it was a very tough time, but I loved the investing. I loved the companies we looked at. I loved diligencing them. I like loved doing deals. And so when I was at McKinsey 5 years later, I really wanted to get back in the private equity industry.
Mm,
And I was told by a recruiter, listen, if you aren't at an investment bank or if you're not in private equity, you'll never get a job. Don't bother. Don't
mm,
bother. So not, maybe not being smart enough to take that advice, I sent out tons of outreach to firms to get hired. And though I got an interview at a secondary fund, and they had a big stack of resumes of people they interviewed, and they gave me a case to review some companies. And having lived through venture when everything blew up, I had become quite skeptical on companies unless there was clear value to invest in. And they were impressed that I saw their portfolio of assets and sort of took a very negative view on everything, or very
mm.
conservative. And they appreciated that. And that's how I got in.
Okay. And so it's not at that moment that you founded Klein Hill. It was
That
maybe
was, yeah, that was just to get into secondary. So that was 2005. So
okay,
20 years
2005.
ago, 20 years ago, 20 years and a month ago. And so I was there for about 9 years, and you know, built up the firm a bunch from when I had started. We were successful, had great performance, and then I left,
Mm-hmm.
and a bunch of investors who had followed me along the way and watched my track record and interviewed me throughout the years said if I start a secondary fund, they'd be not that they would invest, but they'd be interested.
Okay.
And so I had three kids, a fresh house mortgage, had just got my job, had nothing,
Wow.
and so decided to go for it.
And so what was the turning point? What were you looking for in founding a fund by yourself, alone, with three kids and a mortgage?
So I'm still waiting for the turning point. No. So look, we've had a great 10 years. So I think, look, the turning point, I don't know. It's hard work, right? So
Mm,
I think as soon as I was free from the other job, I didn't take months off to learn to cook or learn to, I don't know, go on a trip around the world. I went into the basement, bought a computer, bought pens, bought paper, and started working right away. And I think a few things came together. So one was I really knew this little area within secondaries very
mm-hmm.
well, and it was a higher returning area. And I was very fortunate to have there's some people join up with me who were
Mm-hmm.
like super experienced and really smart and great partners. So early on, that was a great help to get started.
Okay.
And then look, there was some investor conviction in the approach. So
Mm.
sort of these few things got it off the ground.
Yeah, can you explain how it was in 2015 when you started the Kline Hill? How was the secondary market? And so where did you start it in this market?
Yeah, so look, in 2005 when I got started, the industry was about $5 billion. And most people that I talked to in the private equity industry didn't even know about secondaries.
Mm,
So you'd have to explain what they were. So by 2015, secondaries were more common. The volume actually had grown up to 30, no, sorry, to about 40, just under $40 billion per year. This was at a time where year over year, the secondary market was actually shrinking a little bit.
okay.
It was one of the few times it shrunk for a couple of years, but that was happening then. And and I think what had happened was a lot of the secondary funds had taken on a lot of capital. They had grown much larger
Mm-hmm.
compared to my earlier days. And so I think at that point, Kleinhill, and still does, fit in a really important niche to do the smaller deals where the bigger firms had
Mm.
become not bloated, but very large.
So at like at the beginning it was only LP led. No, I presume
90%,
90%. Okay.
80,
So
90%.
yeah, and now when you look back at Kleinhill's trajectory from a few hundred million in asset under management to today 5.4 billion,
I think it's like a
maybe
little over six, but
over
but look,
six.
the important thing isn't the size, it's the returns.
Oh, okay. So maybe for those returns and plus the size, what have been the two or three most decisive, maybe strategic choices you personally made?
Yeah, look, so after starting Kleinhill and after focusing on this less competitive space and building up this platform that was somewhat unique to this big platform with lots of people and lots of relationships to focus on it. The big decisions after that, I think one big shift a bit was starting in 2020
Okay.
instead of only going for the multiple of what we would give investors. So we will double your money. We'll give you 1.8 times, 2.2 times your money back. We were focused a lot on multiple. Starting in 2020, we modified the strategy a little bit to also focus on returning cash more quickly.
So on
The first
IRR.
IRR and DPI,
Mm,
distribution to paid in. And so in the early years, I think we will end up with those funds being highly successful in terms of getting people double their money back or close to double their money back, but I think over longer than we want.
mm,
So starting in Fund 3, we cut out some long dated investments. We focused on some little more mature LP deals early, and we get the cash engine running much earlier, starting in our third fund. And we kept that since then.
mm. And so maybe on your journey along the way, have you had mentors or maybe role models? You talked about maybe partners.
Yeah, for sure. So I've had a number of mentors. So one was, so look, I think it's important that everybody gets mentors in their own like careers, but if
Mm,
you're early in your career, you may not always have them. So I would say there's one book I'll call out in particular, which is written by Peter Drucker. So he's
okay.
one of these early McKinsey consultants back in the day when they were doing like majority of their projects, super interesting strategic projects. And the book was called Effective Executive. So
Okay.
Effective Executive, and I had the books on tape version of it, and I must have listened into the car 10 times. And
Wow.
it's about how to use your time, what to focus on to be effective, and whatever level you are, you don't have to run a company, wherever you are, it can be a very helpful like way to think about everything.
Mm,
And another one was Rob Norton, who was the guy I mentioned, where you look you don't know what you're going to do every day for the next year, and you're not the master of everything, but you can prepare and be ready to crush it tomorrow.
mm,
And so if you can do things really well one day at a time, you can break things up and do really well. So he's a second one. And a third one, I'd shout out a professor in business school, Galen Height. So took a finance class and did a great job at teaching how financial modeling, there's the technical aspect where you have to model what's in accounting statements and model what's in legals and financials. But there's really also an art where you have to think of the businesses and their business models and how their revenue may change over time or their cost may change over time. And investing and valuations really are sort of a merger of the technical science part and there's an art to investing and
mm.
you really need to combine those together.
Great. So maybe let's go back to Kleinhill and the company. You talked about the positioning of Kleinhill. So you were focusing on smaller deals. So you were very in the niche. And whereas you have mega funds, especially maybe not in 2015, but right now you have mega funds, a lot of mega funds fighting for huge deals. So I was thinking if there was a kind of a not like a different approach as a leader, as a maybe as a yeah founder of Kleinhill, rather than if you were like if you were in a mega fund.
Yeah, so look, I think there are multiple ways to, they say, to skin a cat.
Mm,
And so we get it done by the small deals where other firms aren't competing with us. Some larger firms that have had successful models, some have focused on. So Kline Hill, we do secondaries. We now
mhm.
also have a primary capacity.
Yeah,
We're sort of like a fund of fund. We're investing capitals in funds with new capital.
yeah.
Some of the bigger funds, about half, I think, focus a lot on taking their fund of fund strategy and leveraging that to do secondaries
Yeah, of
in that
course.
small list of managers. That's one way. Um, I think that I do think the more capital you take on, the size can start to dictate your strategy a bit. So the
Hmm.
bigger and bigger you get, it becomes a bit more difficult.
Okay. And so do you manage to still focus on small secondaries deal right now?
100%. So if you look at our first fund, which was $180 million, to our current fund, we're just about $2 billion,
Hmm.
a lot bigger. We adjusted for the larger fund size by doing more small deals. So
Okay.
last year we did 150 deals, the
Wow.
biggest volume in the industry, but we stayed disciplined to how we delivered returns and just do lots of little deals. And look, if you work at Kline Hill, we have guys here who are here for a couple of years and they're getting so much great experience
Yeah.
because 250 deals, everybody grabs the shovel and grabs their pickaxes and we're all working hard to get the deals done.
Wow.
Whereas if you did a firm with the same number of people and you did 10 deals a year, at
Mm.
entry level, you might be more narrowly focused. So I think it's great for our team to get a lot of experience.
Do you have like an average ticket size for those small deals to maybe better understand?
Yeah, so we have two buckets on small. We have micro deals, which
Okay.
are sub $10 million for portfolio deals, like very small.
Okay.
And then we have small deals, which tend to be 10 to 30 or 10 to $50 million, which are well below the $100 million
Mm.
area where deals get really competitive.
Yeah. And so those deals are especially in the US or worldwide?
So I'd say that assets are mostly US and Europe. We
Okay.
will buy some Asia, we'll buy some other areas, but we keep it closer
Mm.
to home.
And so maybe can you come back on this strategy and explain to us what was the white space at the time? And right now, do you still see a white space?
Completely. So the white space when back in 2005 when I started, in 2015 and today for Kleinhill, the white space is still the small deals. So why is that? Why has it worked so well for us? And there aren't a million other competitors there. So first of all, there were really strong firms, really hardworking, smart people back in the day. But what happened was they had good returns and they raised bigger funds and bigger funds and bigger funds.
Mm,
And once these firms get to the multi-billion dollar size, they would do the same number of deals each year.
okay.
And so we had the strategy where we do tons more deals, but the other really well-run firms grew in size. Some of the firms that weren't so well run went away. So 40% of the secondary funds from when I started are gone.
Wow.
Yeah.
Because they were bought or
So,
okay.
yeah. Yeah, done.
Yeah, okay.
Uh,
That's clear.
yeah.
Okay.
Um, yeah, and so look, so it's in 2015 when Kleinhill started, there was still not a strong institutional focus on small deals. There were some really good firms, and as we go forward to today, some of those have grown to be much larger. So there's always a couple people in the space, but if you look at what Kleinhill is today, we're in 1,000 managers from having done secondary. So we've transferred 1,000 different managers. We're in almost 4,000 funds.
Wow.
Our primary program is 55 managers. Our team is just under 70 people. And so we have this huge monster platform that's highly focused and works to provide really good service. And
Mm.
so it's in this for like a small deal of like 5 or $10 million, it's hard to get the level of service from anywhere else that Klein Hill can provide.
Yeah, that's crazy. So much you still with this ticket size, even if the fund gets larger and larger, it's a lot of work, I think.
Yeah. And we work really hard to provide good service. So
And so and right now with the surge in GP-led transactions, right now you would say that Kleinhill is maybe there is also a surge in GP-led transaction in Kleinhill.
For sure, yeah. So we launched our GP-led strategy in 2021. We
Okay.
had been doing GP-led deals from the beginning of Kleinhill. However, we strongly believe you need a dedicated team. So
Mm.
for GP-led deals, half of the GP-led deals are multi-asset. So for
Okay.
one deal, you'll buy many companies. Half of the GP-led deals are single asset. We see higher returns in the single asset GP-led deals, and it's a different skill set and requires different investors to do a single company deal than a highly fragmented transaction. And so we built out two teams. We have a different fund
Hmm.
for it, and it's been very successful. So our exits so far, we've like very strong and very good liquidity.
Mm. And so now, if we focus on the secondary market, so maybe a bit of a story, but maybe at the beginning it was kind of perceived as a distress tool, secondary, maybe a few years ago. Now we see that it's changed a lot and it's a kind of a core pillar for portfolio management, for investors, for a lot of people. So now we were roughly to 160 billion in volume transaction last year. We might do more than 20, like than the 200 billion this year. Could you explain how, can you explain the shift and also the perception when you work and when you saw all these changes through the years?
Yeah, absolutely. So a few things happen. So one important one simply is fundraising.
Mm,
And if you look at the last 15 years of volume in the industry, it's been 80 to 100% of what's called the dry powder at the start of the year. So
mm,
dry powder is how much capital secondary funds have sitting uh, in their investment process that they can draw on to do deals. And so every year, secondary funds invest about as much as they have. And
mm,
so there's a very quick turnaround in capital. That's made possible by having good returns. So returns for LPs and secondary funds are double digit net IRR on average. So investors have done well, so they keep putting more money in. So that's driven it a lot. And then pricing is strong. So if you look today, LPs can get 85, 90 cents on the dollar for
mm-hmm,
illiquid assets.
mm-hmm.
And so it's easy to decide to sell if you get almost all your money out.
Okay. Maybe I just have a question that comes to mind. You talked about this white space within the small deals. There is also the surge in evergreen funds. So they need to put money, they need to invest very fast. And so I was wondering if it was not kind of not a threat, but a new competitor in this white space, this white small market.
Yes, no, absolutely. So these evergreen funds have brought in a lot of capital. I think it was $2 billion a month
Mm,
for much of this year, like a lot of money flowing in. However, the way that it works is the money shows up quickly. And often these managers, they hit really quick and fast, need to get it invested into deals. And so the brokers, for example, Evercore, have it at 6 cents more per transaction that they pay because they have
mm.
this very big
Yeah.
pressure to deploy the capital. So they're paying a bit more expensive. And I think there's some issues like the fees are a bit higher for them than for big institutions. And I think there's just I think there are definitely issues today with the evergreen vehicles that are there.
Hmm.
I think there will be evolution, and I think there will be better approaches coming out over the next couple of years. But uh, but I think for today, it's capital that's flooding into the industry. I'm afraid their investors may not get the returns that the institutional investors get. But um, but for us, the deals that they're doing are bigger than what Kleinhill does, so it hasn't impacted us
Okay,
really. But I think they do drive up pricing for bigger deals.
great. So we were talking about this at the before starting the podcast. So you host also a podcast,
Yes.
and that's crazy. And this is maybe how I run into your profile on LinkedIn first. Um, I was wondering how much of your success do you attribute to this ability to build a kind of a community, maybe not only with your podcast, but I put the podcast in the question also.
Yeah, so look, so the podcast is called Secondary Snapshot, and I think like you, it's fun to run. Every
Okay.
time I interview someone, I learn. And so for me, the Secondary Snapshot, which we have on, it's on Apple and Spotify, has been great for me to learn. I don't know that it's helped so much. I mean, to be honest, for me, the motivation was A, I'm having conversations with really interesting people like yourself anyways. Let's record it and share it. Why not?
Yeah.
And then B, if it helps the community, if it helps some people who are early in their careers to launch because they're learning and you help provide for that knowledge pool, that's great.
Mm,
And I think also it forces me to be in touch with really interesting people who are helping drive the changes in the industry going forward. And so it's great to be in touch with them. So I don't know that it's driven investors into Kleinhill or sellers, but for me, it's been a little bit of a time investment, not as much as you'd think,
mm.
but personally helpful.
Yeah. Well, I have the same view with my podcast. I learn a lot, and I'm very happy to share some conversations with people like you.
It's like I also like to entertain. I like to throw dinner parties. I like to throw parties.
Hmm.
Sometimes your friends also do that and you get invited, and some friends don't throw them. It's okay. Like it's
So
your
you the one throwing parties.
you know what? You come out to New York City or Connecticut, we'll get a group.
Oh, that's nice. Okay.
Let me know.
So maybe if we look at this year, so I saw that you announced the sale of a minority stake in Clay Hill to TA Associates. So I was wondering why did you choose to sell a minority stake and what this transaction brings, yeah.
Yeah, so look, I think it was a thing where we'd been approached by 50 firms over the last few years to buy us, like 50. I think that's a
Wow.
lot, right?
But we see a lot right now, like we in France, there was this majority sale of committed advisors, and so I can see that there is more and more appetite in this secondary niche. So it's very interesting to talk about it.
Yeah. And look, to be honest, initially didn't take it too seriously. And then when we felt it was more for real, I think we were meeting a lot of these firms and saw some as maybe a more difficult fit. It could be culture, or maybe it was a financial transaction where they give you money,
Mm,
but then you're handcuffed with them. You're stuck, and you have to be very careful there that they're the right partner. And so I think what happened was over the years, we found some firms who you could see if we merged together, they could
mm,
help our investing a lot. We could be great partners together. And so if some of these firms have, for example, relationships with hundreds of private equity funds, or they have research departments that know the underlying companies really well and would help us diligence better or source deals better. And so we decided that A, it's good for the firm to have some liquidity.
mhm.
Uh, and then B, but narrow it down to firms that would only help our deal process a lot. And
Okay.
then the perfect partner was TA Associates. So they've been around for 50 years. So one of the longest, most storied firms in the private equity industry. If you look at their recent funds, they deliver close to 3 times investors' money back. So in
Wow.
some funds, they've done more.
Mm,
And so highly successful, really smart, nice people, like good people you'd happy to do business with, you'd happily have dinner with, go on a trip with. They're great people.
throw
And
party also with them.
yeah, they're great. They're really a super team. I suggest anyone looking to for a career or to sell a company, talk to TA Associates. It was also helpful. They did a minority transaction,
Yeah.
so Kleinhill retained control. They didn't take any of our carry or the profit share from funds, so
Mm,
everybody at the Kleinhill team still has all of the sharing with deals, so they're aligned with investors. But TA also has helped us a bunch. So they are leveraging their huge platform and they're helping us with deal diligence. They're helping us with strategic projects and things like technology. And then
mm,
they're just great, knowledgeable, experienced people to talk through complicated business problems managing
Mm.
the company. And it's more, they're there to help. They're not telling us what to do, but it's great to get their insights and advice.
And do you still see some traction around maybe potential buyers they like who like try to buy a piece of Kleinhill today still?
No. So look, I think we're very happy where we are for now. Many years in the future, if the right partner comes along, we could work with a big partner. But then also the way TA has gotten their own exits hasn't been from a company selling completely,
Mm.
but 80% of the time it's just from little minority transactions. So
Okay.
who knows what the future holds, but the good
Yeah.
thing is we control the future and we would look for very good partners.
Okay. So let's talk about Kleinhill today to understand better the way you're working today. So maybe to start, which types of transactions represent the core of your activity? Like we talked about small and mid-size LP-led deals, but maybe GP-led. Can you talk about the evolution in the like in the whole?
Yes. So I'd say today at Kline Hill Partners, about 50 to 60% of our deals will be on the limited partner side. As our firm has grown, we stay focused on these little deals. So we are by far and away the largest firm that anyone should go to sell their LP transactions below $50 million or below $10 million. Please come talk to Kline Hill. On the other hand, we are also the leader in the middle market GP-led deals. So if you look
Okay.
at GP-led deals below $250 million, Kleinhill is active in the single asset section of those deals.
Mm-hmm.
And we have a very experienced team dedicated to just those deals. And not only are we happy to work through intermediaries and advisors, but we're in 1,000 managers from our
Mm.
LP transactions, which gives us lots of relationships to use for those deals.
Yeah, and lots of proprietary transactions.
Yeah, proprietary and I think the important thing though is having like a very experienced deal team, very experienced investment committee that have done thousands of deals
Mm.
to be able to make sure we buy the right assets, have lots of upside and limited and like don't make mistakes.
Mm. And what are the core sector focus of Kleinhill, if there is?
Sorry, the core sector focus. So
Yeah.
look, we're more diversified, so we will buy across all different types of industries. When we go to do deals, we like to be diversified, and you're often finding assets just that are across many industries.
Okay. So no specific focus, opportunistic kind of view.
That's right.
Mm. So maybe this particularity of Kleinhill is to be focused on these small secondaries. Maybe to understand on the LP side, when you talk with LPs and you explain your strategy, what why do they choose this kind of small deal focus?
So look, I think the one big thing is our track record. So they can
Mm.
meet us, they can see our returns, they can compare them to other firms, and they're quite strong. A second thing is many of them are invested in other secondary funds, and they may not just invest in one secondary fund. They might invest in two or three or four. And so what they want to do is they might pick one large firm and then a small firm. And so there are many different great firms to pick from on the larger side.
Mm.
But I think when it comes to groups that do small deals, we stand out.
Okay. That's nice. And how do you see your kind of LP base evolve through times? We know that I talked with some fund managers, and they were explaining to me that kind of through the years, this kind of base evolved with the liquidity. So Asia at a time, Middle East maybe those past years, the US maybe in the next years. How do you see the base evolved?
So look, I'd say first of all, the good news is we aren't losing our old friend investors. So typically, what's called the re-up rate. So if you look at the prior fund and how much capital comes back for the new fund, uh, for Klein Hill, it's closer to 130%.
Mm.
In the industry, it's more often 50 to 75%.
Okay.
So for a lot of firms, every fundraise you lose maybe half as much as half of your investors. So for us, they come back and they come back for more, which is a great honor, and we're super appreciative of our LP friends. As we've grown though, we've been able to take investments from larger firms. And so now we're talking with some larger groups, not only in North America. We were more heavily focused in North America initially. We have many good new friends in Europe,
Mm,
some in Asia, some in the Middle East. And so we're getting a more diversified, very supportive group.
mm. Yeah, I can see that you're more and more international, and I noticed that you opened an office in London.
Yeah, and I should mention, even before London, our first international office was Zurich.
Okay. Ah, I didn't
So we
know.
opened Zurich in 2021. And for us, that was a super start because Zurich, you can meet up with all of all of Europe, and you can have, French speakers go to France. We have
Yeah,
Italian, German, and people taking a train as opposed to only English bankers flying in
yeah.
on their parachutes to come in and help you with liquidity. So we really started in Zurich, and it's a great office today. It's like over 10 people now and growing quickly. However, London is a financial hub. There's a lot of secondary deals going on there. So we felt it was important to also have a presence in London.
Mm-hmm.
So James Bradshaw, who we hired many, many years ago from London, we're now sending him back and excited about the
Wow.
presence there.
Great. So maybe we're gonna talk now about maybe like we're gonna go jump into the deals focus. And so I would like to understand, well, you talked about it, but to understand how Kleinhill secures deal. You talked about this huge coverage in the US. So can you talk about it?
Yeah, absolutely. So sourcing deals is a very important thing for Kleinhill and secondaries. If you look at the whole industry, it's concentrated among a few very, very large brokers or advisors.
Mm.
So Evercore, for example, is the biggest. They have about a 50% market share. So
Oh.
half of all the deals pass through Evercore. After that, you have some other really high quality firms also. You have PJT and Jeffries, Campbell Lutyens. And combined with Evercore, maybe they push 80 to 90% market share.
Mm.
And so most of the secondary funds in the industry are going to the same pond to go fishing. Everyone's like putting the poles in, pulling against the same fish, and you can see that's more competitive. So for Klein Hill, we're not doing those big competitive deals like everybody else. We actually had last year 550 deal sources.
Wow.
The five, not the four, 550. And we transacted with over 100 of them.
Wow.
So completely different profile and where Klein Hill deals come from. And where do we get all those? So it's years upon years of doing deals, the smaller deals, building a reputation for doing a good job. Even if it's not a huge check, we're a top partner to get deals closed with. And that reputation has really driven it. So half of our deals, actually less than half, come through brokers, and we love working with all of them, but it's not the majority of our deals, and a little over half are just working direct with sellers who come back to do again.
Awesome. So maybe if we look at a deal example, what would be the green flags and the red flags if you look at a deal? I think it's different whether it's GP led or or LP led, but maybe can you share some examples?
Yeah, look, on the LP side, first of all, we look for the asset quality. So we'd like to see healthy companies, not too much debt, which are growing nicely. So if we're stuck with those companies for many years to come, that we're confident they'll do well, like
Mm,
growing, not shrinking. Second thing is the GP. So we'd like to see GPs who have done well. We actually want them to be making tons of money off the funds and profit share and carry, and that will engage them to do the best job for the assets. So we like successful funds, successful GPs. And then look, we're also interested in the deal dynamics. So the seller, is it just Klein Hill they want to work with, or Klein Hill and one or two others?
mm,
Or did they reach out to 20 people? In which case it could be a big waste of time. So
mm,
we want these different characteristics to come together for LP deals. On the GP led side, it tends to be deals below $250 million. So lower middle market companies call it 10 to 30 million of EBITDA, 10 to 40. And we like companies also with low debt. So Kleinhill deals are generally less than 3 times leverage.
Okay.
We, yeah, so like very low leverage. And we're buying these companies at less than 10 times EBITDA. And usually EBITDA as a percent of revenue is 20% or more. And then EBITDA growth rates around 20%. So healthy, profitable companies growing quickly.
Mm. Thank you for for sharing this. Um, So now maybe we're gonna look to the future and to start. We saw like those recent years or this even recent months, there is the rise of 40 Act funds. So we can see that there is more and more retail engaging and maybe investing in the future in maybe less liquid investments. So I was wondering how Kleinhill see those changes and how can you maybe make the most of those changes right now?
Yeah, so I think the big thing with the 40 Act funds is the structure right now still needs some work.
Mm,
So we talked about how the cash rushes in, so they pay on average 6 cents more than everybody else to get deals done quickly. The fees can be higher. Their actual liquidity isn't that great, so they offer 5% per quarter to
mm,
get your money out. But if you think about it, if you're 5% to get all of your money out could take many, many quarters. And some of them also charge carry or profit share,
yeah.
not when the investor gets their money back, like at a closed-end fund with an interest rate on top of that, but just from one quarter to the next, many of these like take sweep profits, like maybe too quickly. The other thing about them is some of the best times to invest is when the market is crashing and things are tougher. But
Mm,
those are times when these interval funds aren't, the money's not going into them. So the money's going into them when things are hot and pricey and expensive, which may not be always the best time to buy. So for us, we believe in innovation. We believe those funds in a year or two will be very well set up. But I think today we're a little worried
mm.
about the returns.
Okay. So maybe now looking at the next 5 years, what do you see as the biggest opportunities for Kleinhill? So we saw because so those examples are going to I'm going to give some example, maybe expanding into new asset classes like CVC, for example, secondaries. Now they're going into private credit, for example, maybe consolidation among other large players. So this was the question after TA Associates, maybe yeah, Monco, yeah, minority sale, or maybe moving up market into larger deals. So,
The biggest opportunity for Klein Hill is to focus on our returns. So
mm,
so look, we've been successful to date by not changing a lot, by keep doing the smaller, less competitive deals. I would in a million years, I would much rather not grow or not take on other fund strategies if it meant we're going to give our investors bad returns back. So the most important thing,
mm,
stay focused on returns. And that's what you want to be remembered by, right? You did well for your investors. That said, like we have grown over the years, and we
mm,
do see maybe in credit or infrastructure that we can provide good returns to LPs. But like number one thing, discipline the strategy and returns. And then yeah, so I think otherwise we can grow with the size of the secondary industry, we will do that. And if we are high conviction on something like credit or infra
mm.
and a team that can do a better job, we think, than others in the industry, and our LPs want it, sure.
Okay.
But day job number one is stick to our knitting.
Great. So now I would like to talk about the main threats. Well, I understood that with this white space, maybe you don't have those kind of competitive landscape threats. But so I'm going to change my question and ask you, maybe for you, what are the main threats for the secondaries in general overall market?
So look, I think that it's going to see many years of growth. So for starters, let's say there's somewhere between 10 and 12 trillion dollars of private equity assets.
Mm,
LP secondaries are 1% turnover per year. GP leads 1%. Public stock markets have 100% per year turnover. So secondary funds could grow a ton just before even getting anywhere close to that type of liquidity. So I think lots of long-term growth, but for some risks. So if you look at public stocks, long time, a big important part of the economy, but the governments have come in and made them, regulatory burden and very difficult to operate. And so the number of public companies has been dropping and dropping and dropping.
mm,
And so I think one risk could be lots of regulations. Hopefully, the government doesn't mess stuff up, but that would be a risk. Um, and then look, I think for these evergreen funds, if there's a market crash, some of those, like with BREIT, with Blackstone's BREIT fund,
mm.
it grew to be huge. But then when it had a problem,
Yeah.
it was a massive, massive headache for everyone who put their money in. And so my concern would be for the way these evergreens are set up, investors might not understand the liquidity or what the returns will be like. And so if the market takes a turn, that whole sector could see some tough times.
Mm. Okay. So now maybe for the last part of the podcast, I would like to focus on advice for young talents because this was maybe uh, how I started the podcast. So I wanted to focus on advice for young talents. So maybe today, if a student or young professional tells you today, I want to work in secondaries and ideally one day join a firm like Kleinhill, what would you answer in terms of a realistic trajectory over the next 2, 5, or 10 years?
So two things. So first of all, to get into secondaries or private equity or finance, you should know the language of secondaries and the language of finance, right? Like if you're going to go to a foreign country, you should learn to say thank you and hello.
Mhm,
So study. If you're in university, pick some classes in accounting and finance and learn to use Excel, learn to use PowerPoint. They're all very important as the very basic things to know. If you're not in university, that's okay. There's online courses, there are books, there are people maybe from your network you can get in touch with to coach you a little bit. There
mm.
are, podcasts like yours, right?
Like yours also.
And secondary snapshot, like our pod, you're in my podcasts. Um, and so soak everything up. And then if you have friends in the industry or people talk with them about it because if you just study on your own, that can be boring and you may not be conversant in it. So then talk about it, try to
Mm,
read about deals and like be able to speak about it and also as part of this, you'll make sure it's something that you like to do. And then I think that's one part. And then I think a second part is like be a rock star, do really well. And it doesn't have to be your class grade point. My undergrad class grade point was terrible, but when something's important to you or things that matter, do a really good job. If you at your job you're at today, be known of as the star. Like
mm,
put extra time, extra effort, like be really good and at whatever you're doing. And then that will flow over into your work, into your personal views, and your confidence when you go to interview or meet
mm,
people. And then also network. So it's an area where like tons of resumes can flood in. If you can leverage friends of friends or anything to just meet people in the industry, good idea.
mm. So it's also a way of learning, maybe when people share some mistakes they made or they saw. So I was wondering, is there a mistake you made at some point in your career, maybe a deal, a hiring decision, a timing choice that you would not repeat today, and that could serve as a warning or lesson for the new generation?
Yeah, look, I would say for me, I'm a very, what's like intuitive person. So you look at the numbers and you look at everything and you evaluate it that way. but I also have like a gut feel. Like, how does my, you know, stomach feel about a
Mm,
deal? And I think there have been a couple times where my mind saw it was good, my gut was sort of questionable, and I think you really need to know that both have got to tick the box well. And so I think maybe in the earlier days, not a lot, but a couple deals where you you let a couple things slide through, or for example, there were a couple deals where other people on the team are getting up to speed and maybe they've been with us for a few years, and you don't want to always override everybody on every deal decision. You want people to learn a bit along the way. So you
mm,
have to balance making sure that you do only the best deals that you think are the best. Um, but having some range for people to make some investment decisions and get the experience. And frankly, also make sure that people, like I always did a fair bit, but making sure everybody monitors their deals closely to
mm.
see how they perform. So the mistake would be, you know, have your mental scientific side analyze and make sure your gut is also lined up
Mm.
around deals.
Okay, so we're now at our final word of the podcast. So, a final word is yours. What career or life lesson would you like to share with a student listening to us who is wondering whether they should also take the risk of building something in their own name in this industry?
Yeah, so look, it's a little bit like anyone who's watched The Matrix, where there's like a red pill
Yeah, and the blue
presented
pill.
and a blue pill. And do you want to live in the normal world and everything's comfortable and easy, and you can go work at a big company and take a little risk and be happy? Nothing is wrong with that. That's a great career choice. And there's a lot to be said for certainty and comfort, and that's important. But if you want to take the other side, uh, and you want to take more risk, I think you also just need to have the mentality to not walk the line, the same line as everyone else the whole way. And then after 10 years, veer off. I think you need to start to be a creative thinker, to look at things differently, to not accept what society or work says is the right way to get things done, and
Mm-hmm.
like creatively think about how to execute on your career and how to be successful, um, and what you need to learn or network. So I think there's like a whole mentality of not accepting dramatic to say not accepting reality, but sort of, be super open-minded.
Mm-hmm.
And look, for me, I had mentioned before, it's like 5 or 6 jobs in just over 10 years between university, finally getting into secondaries. It might not be a straight line. It might not take 2 years. Don't give up. Don't give up. Keep thinking differently. You're gonna make it. You're gonna do it. Just keep moving ahead.
That's great. Those final words are perfect. So, thank you very much for accepting the to show up in my podcast. It was very nice, and for me, it's the first time I interview someone from the US, directly from the US. So it's an honor for me.
Well, thank you. Apologies. I wish I could have done it in French, maybe a
It's
future
okay.
time. And look, our countries have great histories together over a very long period of time. So thank you so much. I
Thank you
really
so
appreciate
much.
it. It's an honor to
Yeah,
be on. Thank you.
perfect.